Hey, Jason Malabuti here with this week's episode of Jason Talks Tax.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
So this week we are going to be talking about 3 reasons why you are still paying thousands of dollars, tens of thousands of dollars, if not hundreds of thousands of dollars in taxes. Okay? So number one is that you are an S-Corp and you pulled a magic number out of the hat and you are paying yourself $100,000 or more in salary, which is all subject to payroll taxes, when your reasonable compensation as an officer could be way less than 6 figures, which would dramatically cut down your payroll taxes. For example, if let's say you have no idea what you should be paying yourself as a reasonable compensation, and you decided to pay yourself $100,000 officer salary, well, that's $15,000 plus in payroll taxes versus if we did a reasonable compensation analysis, we determined that based on your activities and hours spent on your company, you should only be paying yourself a reasonable compensation of $50,000. Well, then we can now slash that payroll taxes in half, which would be about $7,500 per year. In 5 years, that's about $35,000 in taxes, doing math in my head. So if you put that money into whether it's stocks or real estate, could you imagine how much that money would have grown versus you just paying it in payroll taxes? That's the first one. Number two is that you are a high W-2 income earner, and either A, you're not in real estate, you don't have a proper strategy when it comes to real estate, or another option is you are in real estate but you did not plan it accordingly. What do I mean by that? So normally when you are a real estate investor, passive losses can only offset passive income, which would not offset your W-2 income until you sell the property. Well, if we did proper planning, tax planning, and let's say we qualified you as a real estate professional, or let's say you got a short-term rental and then you qualify for the short-term rental loophole, well, now we could account those losses from your rental property, especially if we did a bonus depreciation for the current year, which is done through a cost segregation report, which is when you are able to accelerate all the depreciation that would have been depreciated over 5, 7, 15 years, and you're able to take all that depreciation now in the current year. Well, now you are able to get a bigger loss, which now you could use to offset your active income. So that's another reason why you could be missing out on a big tax benefits. Another option is that you did not do the planning properly and you don't qualify for the real estate professional or the short-term rental loophole because either A, you don't hit the hours requirement for whatever reason, whether it's the property is too far and you can't physically work those hours to hit the requirements, or number two, you were not educated enough on the qualifications of either the real estate professional loophole or the short-term rental loophole, real estate professional status, or the short-term rental loophole. And now you don't qualify because of your job, the hours that you spend in your job versus how many hours you spend in real estate, or you might not have the average stays in regards to dates for your rental to qualify. So there's many things that could have gone wrong in you not getting that tax advantage. And then number three, another reason why you could be paying too much in taxes, a lot of money in taxes, is that you wanted to save money on tax planning. You didn't want to spend that extra couple of dollars on tax planning, and now you're hit with a big tax bill. Real story, right? I have a client, they haven't filed their 2024 taxes yet. They bought a property for $150,000 back in 2019, and then they sold the property in 2024. It's a rental property for almost $500,000. So now, to make a long story short, they are facing a $30,000 of taxes because of this sale. And unfortunately, at the time, they didn't think about doing a 1031 exchange. They didn't think about reaching out to a tax professional as myself to help create some tax strategies for them to help either eliminate or defer those taxes. So now I told them like there's really nothing we could do now. Unfortunately, now you got a big tax bill, so those are the things that you want to avoid. That's why you want to be always in communication with your CPA whenever you're thinking about doing this big life decision, whether it's buying a property, selling a property, starting a business, selling a business, getting married, right? All those things, having children, all those things are conversations that you need to have with your accountant. So anyway, we're going to have a webinar about this on the end of the month where I'm going to be talking about 3 additional items that you could be missing out on that's causing you to pay, tens, if not hundreds of thousands of dollars in taxes. So I will see you there. We'll put that link below. Register for this webinar. It's going to be 3 new reasons that I did not mention in this video. I'm only going to talk about it in the upcoming webinar. So I will see you there.
Gather the papers, receipts in a row, punch in the numbers, watch the totals grow. Deductions here, refunds there. You're a tax wizard beyond compare.